Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Hello, everyone. Welcome to ICW. It's June. Beautiful weather here in the East. I know that everybody's itching for the summer. Last one before, actually, there is one more summer decision on rates, which is in July. Then we take a long break until September. Today, no surprise, policy rate was held to 2.25. Sherry, inflation, 2.8%. You could argue that's a little high, but at the same time, it's within that neutral position that Bank Canada likes. And lots going on with Kuzma coming up. There's lots going on, of course, with Donald Trump and the Iran war. Just a whole bunch of data just to come at us. And no surprise that the rates were held today.
No surprise at all. And in fact, I think we're going to see stable overnight rates for most of, if not all of 2026.
Do you think there's anything that could tip it one way or the other? I mean, we see this Iran war that kind of goes in and out of, we're going to get a deal done. Don't worry, the oil will start flowing again, to we're going to bomb Iran. So, like, is there one that will tip the other? With actual bombing tip it one way? Will the opening of the Strait of Hormuz be one? Like, what would tip it one way or the other?
Well, Eddie, it's many things. Right now, central banks are confronted with weak economic activity, but inflation that at least is somewhat stronger than desirable. So we've got countries like Australia raising overnight rates. At the same time, when the Fed meets again, which is on Wednesday, 2 days from now, on the 12th, I expect that they'll hold as well. And most other countries are holding because their economies have slowed.
Right. Well, you see, we're in a technical recession here in Canada. So we'll find out what that means. So like every time we have this call, we'll allow Sherry to go through her slides. If you have questions, please post them. We'll get to them as soon as we can. I think this will be another really informative session with Sherry Cooper. So Sherry, over to you.
Thank you. Well, let's begin. Here we are, Iran war. It's the 4th month and counting. And evidently, Mr. Trump has become even more virulent in his statements about he's going to be bombing Iran like crazy because they took down a military helicopter. An hour from now, he could say we're very close to signing a deal to conclude the war. So we're not getting reliable information from the White House, that's for sure. As I just mentioned, the economies all over the world are slowing as a result of the dramatic oil disruption, big increase in oil prices, and therefore inflation. Mexico and the United States have already met to begin discussing CUSMA. Canada is beginning that process, but certainly more to come. I think the bank did exactly the right thing in holding rates. It would be very negative for the economy if they were to have raised rates today. And I think we're starting to see inklings of a housing market recovery, at least from the preliminary data for May. So let's move on for this. The tariff story is back in the headlines again. The tariffs that were introduced way back when, last year, were the tariffs that were put forward under what the US calls IEEPA, which stands for the International Emergency Economic Powers Act. And basically what they did when they started with the tariffs is they introduced them because of fentanyl problems with Canada and Mexico, as well as illegal immigration issues. Now, that may be a real issue with Mexico, but it's certainly a stretch when it comes to Canada. I do think, though, that the Supreme Court actually, when they struck down the rationale for the original tariffs, that of course became a real problem. And now what they are doing is they just in the last few days, they announced a new tariff. Now this tariff will replace the others, we think, but we're not sure. And it's a 10% tariff, and it's based on, the reason is that it wants to encourage countries to be more careful about dealing with goods that are produced by forced labor. Now, again, I find that's a real stretch when it comes to Canada. But, you know, I guess there are products produced by forced labor, and not that it's monumentally prevalent, but it's certainly now another thing that we have to think about as we move forward in this year. What the proposal is now is the new levies will be 10% for the countries that are shown here in pink, and 12.5% for the blue countries. It's all still preliminary, and it could well come into judicial consideration again. But Trump has not given up on his tariff story, that's for sure. So back to what's going on in the Middle East. This is now about a 2-month ceasefire, but if this is a ceasefire, I don't know what military action would look like. Even if they were to open the Strait of Hormuz tomorrow, which is not going to happen, it will take months for oil prices to return to pre-war levels. And no one knows when the Strait of Hormuz will open. But it isn't a slam dunk that it's going to be anytime real soon. Now, the direct effect immediately as the Iran war began, the immediate reaction was skyrocketing oil prices. There's 20% of the world's oil goes through the Strait of Hormuz. So when the strait shut down, as soon as the war began, all of those tankers were stranded. And the countries around the world that import their oil through the Strait of Hormuz have now been experiencing demand destruction. and they have cut back on their oil consumption. In some cases, what they've done is they've lowered they've lowered the taxes on some of the oil. That's something that Canada has done. The other things that we're seeing happening is going to shorter work weeks, telling people they can work from home so they don't have to drive. And clearly, it is a big problem for mostly Asia and Africa. China has historically gotten much of its oil through the Strait of Hormuz, but it's very interesting to see what China has done here. This shows you China's imports of oil, and each of these colored lines is a different year. The red line is the current year, and you can see their imports have just plummeted. Now, it's not that they are using less oil per se, but they had been stockpiling their oil, and their inventories are now being used in order to meet demand. That's helped to take some of the pressure off of oil prices. There were those who were forecasting that oil would reach $200 a barrel, and we haven't seen that. So in some respects, it's because China's demand has come down. Now, this chart shows you the U.S. trade deficit and the U.S. manufacturing jobs. The whole point of these tariffs was to turn the merchandise trade deficit into a surplus and to increase manufacturing in the United States. Well, what we've seen is thus far, the U.S. merchandise trade deficit, that's the trade deficit for goods. It excludes services trade. You can see that the deficit for the US has diminished. It's still a deficit, but it's roughly 100 billion, 75 to 100 billion, as opposed to what had been almost 175. But we have not seen an improvement in manufacturing jobs. They're down, and not a dramatic component, but still 57,000 jobs as a result thus far. Now, consumer sentiment in the US is at a record low, and that's despite booming stock markets and what has been very positive, a very positive economic backdrop, where the economy in the United States is quite strong. Now let's look at Canada. Canada's economy has slowed, and certainly for 2026, we're forecasting now about 0.5% growth this year. But it is not, I believe we are not in a recession. Now, yes, when we saw the first quarter GDP figure last week and it came in at a small negative, where it was down 0.1%, that meant that we had 2 consecutive quarters of negative growth, which is a necessary but not sufficient condition for recession. In order to call a recession, not only do you need to see 2 quarters of negative growth, but there has to be a sizable negative downturn sufficient to slow the broadest measures of economic activity and to slow them considerably. So what we have seen in Canada is, A, this was a very small dip, and B, on per capita terms, GDP was actually positive thanks to the big decrease in immigration in Canada. And by the way, I went and looked at all post-war recessions in Canada, and the average downturn on a quarterly basis during a recession is between 3 and 5 percentage points. You see here, this is like a 1% decline in the fourth quarter of last year and a 0.1% decline this in the first quarter of this year. This is not a recession. This is like scraping your knees as opposed to breaking your leg. So in addition, we have already seen incoming data to suggest that that dip in the first quarter is already being reversed in the second quarter. And I'll show you that. As you can see, these are the numbers I just suggested. Well, the Stats Canada did say that for April of 2026, they're predicting 0.4%. And given that April in the calendar is already behind us, I do believe that we didn't go into recession and growth this quarter will be positive. We see that the interest rates have risen. This is the 10-year Government of Canada bond. The Canadian dollar has fallen. The key takeaways have been that the Canadian economy is much slower than the US economy. And you see it most dramatically in total government spending, which is negative, and particularly so if you look at the capital part of government spending. Business investment, big negative here, very strong positive in the US thanks to AI. And then residential investment, minus 7.8%. I don't need to tell this audience that number. But again, the US has had a slowdown in housing, but nowhere near as dramatic as what we've had in Canada. And another thing that is really interesting is the Canadian imports have surged. Now, imports are subtracted from GDP. If you remember back to your principles of economics, GDP is consumption, government spending, business investment, and exports minus imports. Our imports surged 12%, and the bulk of that is a result of gold imports, which is not considered part of the underlying basic fundamentals of the economy. So the weakness in our economy has been largely trade induced, and a surge in gold imports and soft domestic demand helped to contribute to that. Now, Canadian retail sales rose in March, latest data available, but the gain was the direct result of the run-up in energy prices. When you saw the payment for gasoline, that's really what pushed the number up. Total retail sales grew. This is the third month in a row. And though 12.4% of the increase was the result of the rise in gasoline prices, if you take that out, core spending dipped slightly. So again, Canada underperforming. Now let's look at where this fundamental is, and clearly it's in the tech sector. Canada is trailing in the tech race. This is a chart of real business investment in high technology. And as you see, the United States, you see it's an exponential increase in investments for data centers, all to help develop artificial intelligence. For Canada, there's been a slight increase in business investment, but nothing like what we're seeing in the United States. And that has had a dramatic impact on our real economic data. This shows you real GDP growth year over year, percent change for Canada, which is virtually zero, and for the United States. And the biggest explanation for the gap between the two countries is here: real business investment. The US investment in all things to do with artificial intelligence has been stupendous. And it's meant that the growth in the economy is much stronger. And the stock market, of course, has been dramatically different. Here I show you productivity in the two countries. And you see that once again, since 2022, we've had a big increase in US productivity growth. And for Canada, you see still declining, flatlined at a negative level. Very, very unfortunate. The good news is, though, as more and more Canadian businesses adapt artificial intelligence and build out the data processing centers that will be needed here, we should also benefit in terms of improved productivity. Now, this shows you the stock market, Canada and the United States. Canada has moved up sharply, largely as a result of the energy sector and the banks, the financial sector. The US, much, much stronger. And US stock market up 7.1%. And that's, all of this is just since February 27th. This is just since the beginning of the Iran war. So what we did was I put together the numbers and based them on February 27th as 0. And then that way we can look at what's happened since then. And you see the US stock market has majorly outperformed the Canadian stock market, even though the TSX has done pretty well. And again, consumer confidence, record lows. So that's the one thing we do have in common with the United States, is that in both countries, consumer sentiment is extremely negative. Now, as Prime Minister Carney has told us, what's essential now in this new world is that Canada has to expand its non-US trading relationships. The US trade is uncertain, and certainly, just today, President Trump said again, we don't need anything from Canada. We don't need anything from Mexico. I don't see why we need this free trade agreement, which is the agreement, by the way, that he signed in 2017 when he was president the first time, and lauded it as one of the greatest free trade agreements ever. Now he's obviously changed his mind, but what do we see in terms of Canada's ability to diversify away from the United States, both in terms of imports and exports? Well, I believe Canada has a huge competitive advantage. Abundant resources, a strategic location, we're a reliable trade partner, we have a highly skilled workforce, we have political stability, critical minerals, fresh water, substantial food production, energy of all sorts, whether it's oil, natural gas, hydroelectric power, nuclear power, and sustainable wind and solar. We've got it all. We have sustainable forestry, the Arctic access that Trump wants so badly from Greenland, world-class infrastructure, et cetera, et cetera. So it shouldn't be a hard sell for Canada to trade with other countries. And here you see it's already beginning. This looks at our goods imports. And what the blue line is our imports from the United States, which have fallen considerably. And this looks at our imports from the rest of the world, which has increased considerably. So we're buying more from non-US sources, which is exactly what we need to do. And not just on the import side, but on the export side as well. Now, we are certainly attempting to negotiate CUSMA with the United States. The U.S. has already met with Mexico. The U.S. would prefer to negotiate one-on-one with Mexico than one-on-one with us. But regardless of how it's done, this is not going to be resolved by the July 1st mandatory date for renewal of the free trade agreement. The July 1 date, though, it doesn't mean that as of July 1, if we haven't come to agreements, that the CLISMA no longer exists. It just means that they will continue negotiating and the free trade agreement will remain in place until it's either fully negotiated and everyone signed off on it, and then it goes on for another 36 years, or the whole thing is thrown away. Now, that would be the worst possible outcome of these negotiations, because the U.S. is difficult enough to deal with, and most of the tariffs that have been imposed by the United States are exempt from the goods and services that are traded under CLISMA, which has made a huge difference for our economy. Now, what are we going to do? Well, Canada is still very important to the United States. We remain a critical trading partner, but U.S. trade has been shifting more towards Mexico. That's been largely in the automobile sector because labor costs are much cheaper in Mexico. The CLISMA tariff protection is under scrutiny and therefore uncertain, but we need, therefore, to attract new trading partners. And what I show you here is that diversification in our trading partners is gaining momentum. This looks at the change in Canada's exports of goods since 2024, when the first tariffs were announced. You see that for the United Kingdom, trade has increased. Exports to the United Kingdom have increased by 33%, but there's a cautionary tale here. Most of that is gold exports to the United Kingdom, which is not an ongoing flow. It's a one-shot change. So that biases upward the amount of exports going to non-US countries, which are currently at about 50 billion. And then you see here that our exports to the US are down almost 57%. So we've offset, the actual offset is an 88% offset, but that's still, it's not a sustainable offset, again, because of the gold. But we are making progress, clearly. And we've seen many trade decisions and announcements made that haven't shown up in the data yet. Now, looking at the tariffs more closely to see where in Canada we've been hardest hit, these are the tariffs over the course of every time he changed tariffs during 2025 and this year. He made new numbers for us. So Quebec has been hit the hardest. Their effective tariff rate has gone from 5.3% to 9%. And Quebec is very much involved with hydroelectric power and aluminum, which has a 50% tariff rate. Lumber tariffs are 14.5%. So clearly Quebec is under pressure. Ontario would be the second hardest hit. We're the producer of steel, not to mention the automobile sector is so important in Ontario. Here I've shown you where the exports have declined, and you see that the biggest export declines, they're down 27.5%, are in the sectors that have the highest tariff rates. which is certainly what you'd expect to see. For Quebec, the most recent data I have are, in terms of the details for aluminum, are still 2025 numbers. But the good news there is that, yes, our exports to the US have declined sharply, but we've offset it with an 18% increase in exports to Europe. And similarly, in the aerospace sector, thinking Bombardier, found buyers in China, Germany, and France, where iron ore has shifted to China and further offsetting the lost demand in the US. So in terms of aerospace and iron ore, we are offsetting that as well. But there are 170,000 people that work in Quebec industries affected by the tariff, and 300,000 Ontarians that also are affected by the tariffs. So it is a big deal. Our employment data was a big surprise for the month of April. A huge increase in net employment, 88,000 new jobs created, and the unemployment rate fell from 6.9% to 6.6%. If nothing else, that tells you that our economy is not in a recession. Now, the employment surge follows 3 months of negative employment so far this year. So we know this has been a weak labor market. But the good news is that momentum remains, and there's much, as I've said, that's happening that look positive as the unemployment rate dipped down. And we've seen the unemployment rate fall in particular for younger people, which is great because the unemployment rate for people aged 15 to 24 had risen to above 13%. So there has been some improvement there. Now, the real layoffs are happening in the US and Canada in the tech side. And because the tech companies are spending so much money on their AI investments, they are working very hard to reduce their labor component, their labor costs. So Microsoft, Meta, Rogers, Google, or Alphabet, you name it, Apple, all of them are announcing big layoffs. And as well, businesses increasingly, when they can substitute AI for lower, let's call it entry-level jobs, or jobs that are more easily AI replaced, we'll see further declines in employment. Now, I've taken the employment numbers and we've moved them into 3 sectors. The one sector that has very little exposure to the United States, mainly because there are no exports to the US. That's the blue line here. The green line is the public sector, which doesn't export to the US. But the 8% of the economy, it's 8% of jobs that have a high reliance on US exports. Now, the job losses here mean much higher unemployment in those sectors, but again, it's only 8%. Now, to say only 8%, we sure wouldn't want to see 8% unemployment rates in Canada. We're already at 6.6%. If you were to add another 8 to that, obviously that would be a very deep recession. It's not that all jobs are lost. And in addition, as we invest more, even in those sectors, in robotics and AI AI, robots for manufacturing, we could see a substantial improvement in those sectors because we will have seen a big increase in productivity. So on the inflation side, and that's the other part of what the Bank of Canada is concerned about, the latest inflation data for Canada were just released this week, and that's for April. I'm sorry, it was a week and a half ago. That's for April. We saw the CPI rise by 2.8%, weaker than expected. And the average in terms of the core inflation numbers were 2%, which is right on target. So this is not the kind of inflation story that would lead the Bank of Canada to tighten monetary policy when they made it very explicit in today's press release that they see our economy is in a situation of excess supply. So the economy is soft, the labor markets are soft, and there's so much uncertainty and instability that the last thing the Bank of Canada needs to do is make the situation worse by hiking the policy rate, the overnight interest rate. We have already seen market-driven interest rates increase because of the inflation concern of rising oil prices. So this shows you the core measures of inflation that the Bank of Canada looks at, and you see both of them are far lower than the headline figures. Also, the bank made a big point in mentioning this in their press release today. This shows you the breadth of inflation, the share of the CPI that's growing at over 3% annualized rate. You see that has increased, but this, if you look back historically, it's around the average level for this calculation historically. So the Bank of Canada basically is not too concerned, and therefore held the overnight rate steady for the 5th consecutive time. Now, the uncertainty over the duration of the Iran conflict has certainly complicated monetary policy decisions. The US Fed has two targets. One is inflation at 2%, but the other is non-inflationary growth should be maximized. The Bank of Canada only has one target, and that's inflation. But clearly, the inflation numbers have a lot to do with what's happening in domestic economic activity, and the Bank of Canada is proceeding very cautiously. We would call this a dovish hold rather than in June. We saw, in May, it was late April, I guess was the last meeting, we saw a hawkish hold where Tiff Macklem actually commented that he might have to raise interest rates several consecutive times. That spooked the markets. Well, we heard none of that this time. Really, what we heard was that they're comfortable with holding rates steady because that inflation is under control, and they said that they have not seen a spillover yet from high oil prices into other sectors of the economy. So the housing sector, Canada has seen a huge dip in property prices. We led in the pandemic boom in housing, so it's not surprising that we're leading in the bust. Canadian home prices have fallen 18% nominally from their peak in the first quarter of 2022. That's the second largest home price decline in the world. The number one is China. And I'm sure many of you have read all about the problems of overbuilding in China. So We don't really want to be in the same bucket as China, but clearly there's been overbuilding, at least in the condo sector in Canada. And housing is much more important in Canada than in most other countries, and certainly a much larger part of the Canadian economy than in the US. So the housing share of GDP is 7% in Canada, about 4% in the US. And therefore, the Bank of Canada watches housing as closely as they watch inflation, regardless of whether they say that or not. So they would have concern about over-tightening in a housing downturn. And so they do have an easing bias with weak housing and weak consumer confidence. So this shows you, we've seen the overnight rate cut all of these times from last year, and then subsequently we've been on hold, as I said, for 5 meetings. And I think we're going to be on hold for the rest of the year. Now, this chart shows what the market is forecasting for the overnight rate. And the overnight rate is expected to rise by 100 basis points in 5 years. But as you see, only 50 basis points 1 year out. So in other words, by the middle of next year, markets are forecasting that the Bank of Canada will have hiked interest rates twice. Now, I think that's too aggressive. I think that by this time next year, we could well see the Bank of Canada having increased rates once. I doubt twice, but again, none of us know for certain. And this shows you mortgage rates in fixed versus variable. And clearly, with all the refinancing that's going on right now, most people are refinancing at higher monthly payments or extending their amortization considerably. Now, this has shown you, these are these Canadian Real Estate Association data for the month of April. The May numbers for the country as a whole won't be out until the 15th, but we've seen some preliminary data to show that May has experienced a significant uptick. So monthly home sales did pick up in April with a very strong handoff to May. New listings increased in April, although they fell in May. Sales to new listings fell in April. And the MLS price index edged down yet again. And looking at the May data for Vancouver and Toronto, we see the sales have picked up. New listings, however, declined, as did prices. So the takeaway is sales are rising into a still soft, balanced housing market. It's not really a seller's market. It's not really a buyer's market in the aggregate. But when you look at particular regions, clearly in Toronto, Vancouver, these are sellers' markets where sellers are highly motivated, and it is taking longer and longer for properties to sell. What we're seeing is that empty condos continue to pile up in Toronto. The developers are stuck with a record number of unsold units, and that, of course, puts downward pressure on prices. Real home prices, in other words, adjusted for aggregate inflation, as well as the actual decline in the nominal price of homes, the real home price decline has been 30% from the peak in the first quarter of 2022. That's adjusted for inflation. So it's a long, slow downturn. And and it varies considerably from region to region, as it always does. And it varies between the segments in the housing market. Single-family homes have performed the best. Smaller condos have performed the worst. So higher interest rates, affordability challenges, and economic uncertainty continues to weigh on the housing market. But again, as we move through the rest of this year into next year, I expect to see a considerable improvement in housing and in the economy, the economic numbers as a whole. What we have seen is this improvement in affordability, but that improvement is poised to taper off nationally. And ownership costs as a percent of household income in Canada is rising everywhere, as the expense is enormous. And when you look at it relative to incomes, this is really shocking. In Vancouver, almost 90% of average income in Vancouver would be needed to afford a home, like to cover the ownership costs of a home, the average home, the benchmark average price. It's a high 60, almost 63% in Toronto. For the country as a whole, it's 52.4, biased considerably by these two provinces. And then as we move through the country, Edmonton is very affordable at 33.2% of income to cover ownership costs. So it's been this way forever. This is nothing new, but at today's levels, this is a considerable fundamental. We have seen the gross debt servicing ratios come down, both in terms of with the stress test and without the stress test. So homeowners do have some borrowing room, but they are, as I mentioned, renewing their mortgages at higher monthly payments. Mortgage arrears have increased, which is what you'd expect with a weakening in the economy. And it is the highest in, of course, Toronto, very significantly higher than elsewhere. The cuts in immigration have reduced housing demand. So unsold new homes are at a 30-year high, and construction costs have surged about 70% since the pandemic. Household formations have come down very strongly, as housing starts now are above the level of household formation, which is a big change since the permanent immigrant numbers. The goals for those numbers were massively reduced, and temporary workers were cut, as well as foreign students. The population growth of this, it shows you the working age population growth, which of course is now roughly zero. Again, more fodder for the weaker housing market. But this weak housing market is clearly an opportunity, especially for first-time home buyers. We've got negotiations going on in dealing in homes, purchases, and sold. More and more sellers are very eager to sell, and therefore buyers have more negotiating power. Sellers are cutting prices to attract offers. They're willing to have more flexible closings. They're motivated sellers, which means better terms for buyers. So this is a unique window for first-time home buyers and for the move-up market as well. So it's a better story, Eddy, than what I thought we might have seen coming into this meeting. But of course, the uncertainty continues to be with us. Thank you.
We appreciate it very much. I want to just talk a little bit more about housing, because I think you said a few things that are important. One is the opportunity for first time in a long time. First time home buyers are getting into the market, or maybe looking to get into the market. Pre-approvals have risen with brokers. Pre-approvals are so important, especially when rates are uncertain. Could be a rising rate environment. I know our brokers have been doing a great job with pre-approvals. So if you are a consumer looking to buy, please contact one of our mortgage professionals at dominionlending.ca. They can walk you through a pre-approval. Really important that you have that. But those opportunities, like, we haven't seen them in a while. You say it could be short term. I don't know, but we know that the bottom is near if we're not there already. Nobody really wants to buy on the way down, but nobody minds buying on the way up.
Right.
And so we are feeling like, I'm feeling, and I'm following a few markets, and the brokers can chime in as they follow their markets and see more pre-approvals, that there is opportunities. And by the way, big subject in the media is if you're renewing, and of course you're most likely renewing to a higher rate. If you want to refinance, it's a little bit more difficult, but calling a mortgage broker and going through that process can really help you. One, if you need that refinance and that lender that you're with can't give it to you, the broker can find someone that can. Maybe you have to go to a second mortgage. Maybe you have to go to an alternative lender, but at the same time, they can give you that information. And number two, can help you negotiate with your current lender. So brokers can do that.
Right.
Don't worry, if you're just renewing, they're not going to take it away from you. Chances are, if you paid on time, you will get to renew. The refinance piece depends on the equity in your home. That's something a broker can walk you through and help you. If that current lender can't help you, then maybe find you another lender that could. So again, contact one of our mortgage professionals at dominionlending.ca. HST rebate, you didn't talk about that, but that seems to be generating some interest.
Yeah.
I know that my Facebook ads are full of new construction, and they're right there, regular $869 for whatever that discount, $700. So you've seen these big, wide discounts on new homes, which, is great. And I'm hearing that, and you can tell me, Sherry, we're seeing really good production in the new home sales, and they're actually moving. So that's great. So there is opportunity. I love what you said. There's opportunity out there. You just got to find it. And the other thing that I wanted to just quickly talk about is the GDP number that you put up there. Like, you look at that and you think, wow, like this is serious. Like, what is it going to take Canada to in GDP? Does that not flow to everything? Isn't GDP one of the most important data numbers when it comes to an economy, when it comes to confidence? Like, I see that and I go, whoa, that is a little bit worrisome.
Well, that's why consumer confidence is at a record low, but it's at a record low in the U.S. too, and their economy is much stronger.
Yeah.
Well, I mean, the whole world, I bet if we could have consumer confidence data for the planet, it would be at a record low. And, everyone is impacted by what's been happening in Washington.
Yeah.
So, who likes higher oil prices other than the energy companies? No one.
Yeah. And the other thing,
it's such a visible price, it's like you can't help but see it everywhere.
Yeah. And it's, you know what, and you know how Canadians get used to it, right? So we we are that creature that, oh, you know what, we're paying $1.80, $1.90, that's okay. It gets to $1.70. There's a line up at the gas station to get it at $1.70 because it's a discount, right? It's just amazing what we get conditioned with. The other thing was Vancouver housing 88% of income on the average. Whoa, that just hit me pretty hard. I mean, 60-something% for Toronto was bad enough, but wow, that is amazing. And all our Albertans, all the brokers in Alberta are smiling because 30%. I mean, you can have a nice life, go on vacations, and drive a nicer car when you're buying in Alberta. So those.
Well, especially in Edmonton, which is cheaper than Calgary, and Calgary actually is experiencing home price declines now in the aggregate.
Okay. Yeah. Okay. So I got a couple of questions. We only have 5 minutes. I'll get through as many as I can. First one's from Nina Parwar. Can they increase the amortization to 40 years or 50 years like they are? Look, no, it's not.
No, not going to happen.
I mean, it was harder enough just to convince them to go to 30 years.
Right.
Go to 40. Yeah, I don't blame you. And that's the Fed should raise rates, but what happens if they don't? And Canada should follow. So as the U.S. raises rates, and they might, I don't know. I mean, inflation is way higher. Would Canada just follow the U.S. or would we have our own data?
No, we have an independent monetary policy. I didn't mention this today. I wrote about it this morning, though. Today, the CPI inflation for May was released in the U.S. Yeah. And it was big. The headline was 4.2%. But core inflation is at 2%. So basically, the market seemed to be ignoring it.
Okay.
And still believe it's widely held that the Fed is going to hold they meet this week as well.
Okay. Jason Nugent. Hey, Jason. Data center construction seems to be popping up in the U.S. economy, but that's not real long-term job creation. So what happens when that stops? I saw that China's building data centers under the sea. Russia's building them in space. Like, these data center conversations are very interesting. They're building them everywhere.
Here too. I mean, but people don't want them in their backyard. So that's an interesting issue. I mean, it's not like we've got a lot of the empty land, but it's just not in Toronto or Vancouver or anywhere near.
Yeah. And then I think it was Musk that said his Teslas can be data centers as well, and they could be driving around data centers that companies can use to store data. I thought that was pretty clever. One more question here from Alejandro. Hi, Sherry. Canada is incredibly rich in natural resources, but we often export them as raw materials instead of transforming them here into higher value products. What would you do to help Canada build more domestic processing, manufacturing, and value-added industries so we create more jobs, wealth here at home? I always wonder that too. Why aren't we, harnessing what we do best, what we have the most of? Why aren't we doing more for Canadians? And what's the answer to that question?
Well, you know what, Eddie? I don't know, except, inertia or, interprovincial trade barriers. We don't have a huge market. That's why we're so dependent on trade. But you're right. There's no reason why. I believe manufacturing, if we were able to replace expensive labor with highly trained humanoid robots, which is clearly not science fiction any longer, I think we would be amazed at how successful we'd be. Yeah. But it's like you have to take risk, and we don't have the depth of capital availability that the United States has. It's very hard to get venture capital in this country, and even harder to get angel capital.
Yeah.
So that's part of it. The other part of it is we've always had the biggest market right next door, and so we exploited that rather than trade domestically. We don't even have the ability to export oil from one side of the country to the other side of the country, which is crazy.
Well, Sherry, thank you. Appreciate you. We have one more in July, and then we get some time off. I hope you get to enjoy your summer. For everyone that tuned in, thank you for your support. We really appreciate you, and all the best till next time. Take care.